we go.
Just because I'm mindful of time. Good work there. Very good. That'll be good. Hi, how you going? Grab a seat. All right, so welcome. We're talking about the small business concessions today. So specifically the conditions that you need to satisfy in order to access the CGT Small Business Concessions. So I want to try and tie in, tax and Christmas. This is pretty much as close to Christmas presents as you'll ever get for a client, is to access the small business concessions. You can get essentially $4 million tax-free for a mum and dad taxpayer if they can qualify for these concessions. So they're big biggies. And because of that, as you'd imagine, the concessions are particularly complicated. Probably too complicated for really the small business market for which they're designed. And that's a bit of a worry. Because we've got numerous conditions. We're going to go through what they call the 3 basic conditions. However, within each of those conditions are separate sub-conditions. So they haven't made it easy for us to work our way through and determine whether our clients can claim these concessions. Now, it was about 4 years ago that I ran this session before for these groups of accountants that I speak with. And the reason I wanted to run this again was not just because it's been 4 years, but also because of some recent changes. So 2 months ago, royal assent was given for legislation that was passed effective 8th of February 2018. And that adds 3 more sub-conditions to the 3rd of the basic conditions when a taxpayer is selling shares or units in a trust. So they only complicate it further when you're selling shares or units. They don't apply to the sale of goodwill or land and buildings. So at least that's some comfort. And as I said, that only just got passed, so I wanted to tie that in as well. What I did keep from 4 years ago was this table because A, I don't think they've updated it, and B, I don't think it's probably changed in terms of its results. So Uni New South Wales Business School did a survey of small business owners in relation to these concessions and said, questions around the concessions, whether they think they're eligible, what they would mean to them, that kind of stuff. Only 14% of small businesses thought they were eligible. So 14% of the group for which this is targeted thought they were eligible. 58, interestingly enough, obviously had a view that they weren't eligible. I think probably the honest ones were the 28% who said, I don't really know. Because that's really what your answer should be, without going through all the facts. And then they actually looked at people who used the concessions when they were eligible, and only 80% of those that used them were eligible. So that's a little worrying as well. So the opportunity is, if you're across this for your clients, you're probably ahead of a number of other accountants who do struggle with this, mainly because they don't see it that often. And these are particularly complicated provisions if you're going to look at them once every 2 or 3 years. It's going to be a struggle. They aren't easy. The threat, though, is that the tax office, because of the generosity of these concessions, has spent a considerable amount of time, certainly the last 3 years, where they will specifically review your claims for the small business concessions. So when a client lodges a tax return, claims these concessions, expect a review. So unlike lots of things that accountants are lucky enough to do and get away with, because the tax office doesn't ever follow up, this is not one of them. They will review this. So get it right. Be sure that you've gone through your checklist to get there. So let's go into the basic conditions. Let's go into the 3 conditions that open the box to all these various CGT concessions. So first dot point's pretty self-explanatory. We obviously need a CGT event. We need to have disposed of an asset, and we need to have derived a capital gain. Obviously, we're not going to be looking to reduce losses. We're only looking to reduce gains. And I said there were 3 conditions. I can't fit them all on one page because they have sub-conditions to them. So the first condition is essentially one of 4 sub-conditions. The first subcondition is that the taxpayer, so the entity that sells the asset and makes the gain, must be a small business entity in that year. We'll go through those tests. You're probably well aware of them, but we'll go through some of the issues there. Or, if they're not a small business entity, then they need to satisfy the maximum net asset value test, the $6 million test. And they've got to do that just before they sell the asset that generates the gain. So another confusing thing for these conditions is the test time is not always the same. So you're an SBE based on either last year's turnover or this year's turnover. You pass the $6 million test based on your net asset value yesterday. So there's different test times. The bottom two subconditions within that first one deal with, I suppose, some inconsistencies in structures. So a partnership is an entity that can carry on a business, but a partnership is not an entity for CGT purposes. Partnerships don't generate capital gains. So they could then never qualify under that SBE test unless we put in a special test that said, well, if the partner, who is the CGT individual, is a partner in a partnership that is an SBE, then effectively they're an SBE at the partner level. And the asset they're selling is obviously the interest in the partnership. The second of those extra conditions deals with passively held assets. So it is not uncommon, in fact it is highly recommended, that if you're running a business, that you keep assets out of that business. So land and buildings might be in a trust and a company runs the business. Standard kind of asset protection type structure. You want to sell those land and buildings, well, that trust isn't carrying on a business. So it would be precluded from accessing that initial SBE test. So there's another sort of sub-test that says provided the trust asset is used in the business of an entity connected with it, so the company must be controlled by the same people that control the trust. Typically that would be the case. And the company is itself an SBE, then we'll treat the trust as an SBE. So we can connect, in a sense, the trust to the business carried on by the company. We'll go through certainly those first two, the SBE and the $6 million test. Second of those conditions, a little simpler, is the active asset test. A little simpler in a sense that it doesn't have too many sub-conditions. So the asset we're selling needs to be an active asset. And there are some rules around what is an active asset and what can't be an active asset and when you need to test it. Again, a completely different time to those first sub-conditions. So we'll go through that. The third condition, and this is the one that has been further complicated by those changes in February 18. And this only applies as a basic condition when the asset you're selling is shares in a company or units in a trust. So that's important. If the individual or a company or a trust is selling business assets themselves, they don't need to worry about this condition as a basic condition. But if the taxpayer is selling shares, if it's a trust that's selling shares or it's an individual selling shares and they want to claim these concessions, then they need to pass this third basic condition. And it has two parts that then lead to the three additional parts. So the first two parts, the taxpayer selling the shares must be a CGT concession stakeholder. Lots of confusing and long-winded terminology in these concessions as well. A CGT concession stakeholder is an individual, so it can't be an entity. An individual who owns at least 20% of the shares in a company or 20% of the units in a trust, or who is married to, is the spouse of, doesn't have to be married to be a spouse, is the spouse of another individual who has a 20% interest in a company or a trust. So that test only applies when shares are held by individuals. It doesn't apply when shares are held by trusts, which is the common structure. We have a trust own the shares in a company. So that's why that or is there. if there's an interposed entity between an individual and the company in which you're selling the shares, then the interposed entity must satisfy what they call the 90% test. And I'll leave that to a diagram later to explain it to you. I don't want to confuse you until the end. Try not to confuse you too much at the beginning. So we'll be looking at a 90% test. We just talked about a 20% test for the concessional stakeholder. There's a 40% test when we deal with connected entities, and there's an 80% test when we deal with active assets. All simple stuff, isn't it? Small businesses would be all over this. Why do they need to go and see accountants? Crazy stuff.
That 20% figure, that's new, isn't it? It used to be 40.
No, there is a new 20 as part of the 40 test. That's a different test.
Okay.
So you're right, there is a new 20% test, but I was talking about the old 20% test. But the new 20% test comes in this new stuff from February 18. If that wasn't confusing enough already. So we get through one of those top two, and then we've got to apply all of these next three. So if our taxpayer that sells the shares didn't pass the $6 million test, so that means they passed the SBE test, then they must have carried on business before they sold their shares. It's just a timing issue. I'll explain why they brought that in and what that means a little later. Secondly, the object entity, which is the company in which they hold the shares, that also must be a small business entity or satisfy the $6 million test. And this is where that new 20% test comes in terms of working that out. That's a big change because that's not what we were expecting, and that's not what they said the changes were there to deal with. That's effectively limiting what entities and shareholders can access these concessions. By not just looking at the shareholder and their assets, we're now looking at the company and its assets. And that's massive. That's a massive one. We'll go through that. The third one applies a modified active asset test if the object entity, so the company in which you own shares, also owns shares in another company. Now, thankfully, for most of us, that would be rare. It would be rare that a company that your clients ran also owns shares in another company. That also has another modified 20% test and requires further testing at that later entity level. We'll get to that a little later. All right, so let's jump into that first condition. And the first part of the first condition, typically this is where people go because I suppose it's a bigger number, 6 million, than the turnover figure of 2 million. So people tend to look here first, unless they're very clear it's a little small business turning over, relatively smallish amounts. This test, as I said, needs to be satisfied just prior to the CGT event. So if we sell the shares today, we need to work out the maximum net asset value of the taxpayer yesterday, just prior to the CGT event. So this isn't one that you can do any planning or advice on when the client rings you up and says, last week I sold my business. Because it is what it is. That's the day. So ideally, and you'd like this for a number of reasons, you want to be involved before that sale occurred. We're not only looking at the assets of the taxpayer that sells the asset. We're looking at the assets and liabilities of affiliates of that taxpayer. We'll talk about that. And connected entities of that taxpayer. Affiliates, we only include business assets of affiliates where those assets are used in the business of the taxpayer. Probably fairly rare. Connected entities, though, we include all of the assets of connected entities. So that can be nasty. If you're trying to keep a value under a number, $6 million, then the more entities' assets you're adding to your assets, the more likely it is you're going to get over $6 million. So we don't want many connected entities. So we'll talk about how you get them and I suppose how you can stop them being connected. Net asset value essentially means the market value of the asset. Net means less certain liabilities. So we've got to start with market value first. No definition of market value. There's a very long and wordy document by the tax office that outlines their views on valuations, but it pretty much just says if it's an acceptable valuation methodology, then that should be acceptable to them. The problem is that, like forecasting the weather or interest rate rises, valuations are fluid. So two valuers will generally not ever agree on anything, which is a problem when you need to be under a number and the tax office wants you to be over a number. So when you're close to that number, there are a lot of disputes, and this is quite a litigious area in terms of the tax office looking at whether valuations are correct. They take the view that, again, we can't define value, there are various methodologies, but you look at the principal in Spencer's case, old case from the 30s, the price of willing but not anxious buyer would pay to a willing but not anxious seller. Fine. Everyone's anxious these days, so I don't know where you get that. Arm's length, not related parties transacting in an open market, that kind of price. Fine. What's that number? Well, you can imagine there are differences in opinion. Most of these differences of opinion arise in related party transactions. So families passing assets around or moving to other entities, clearly the sort of willing but not anxious buyer seller thing goes off the table because they're related parties. So you clearly need valuations there. There are also scenarios where unrelated parties might be considered to not necessarily have paid market price for an asset. So Citadel and Holdings was the first of these sort of attacks on the valuation by the tax office that made the court. And quite an interesting case because the tax office argued, reasonably, that the $8.9 million sale price for the marina that the company sold was the market value, because it was sold to third-party consortium of investors. Not an unreasonable thought by the tax office. The taxpayer, though, said, well, no, we had this valued at between 4 and 4.5. We believed it was worth between 4 and 4.5. But we were approached by these guys who really wanted to buy this marina. They were anxious, and we put out a number, 9 million. We accepted 8.9. Suckers.
Absolutely.
Absolutely. So they argued, when I'm doing my, well, it was the $5 million test back then, when I'm doing my $5 million test, I'm including 4.5. Less my liabilities, and I'm well under. Tax office is saying, hang on, no, you sold it for 8.9. So you get left to a court, which is not the best place necessarily to argue valuations, to determine what it is. Now, the court didn't necessarily need to determine the value. It needed to determine whether the value was essentially net under or over 5 million. And there's a fair gap between 8.9 and 5 million versus 4.5 and 5 million. So I suppose in a win on principle, the court accepted that the value was not 8.9 million. But it could not accept that the value was less than 5.3 million. They had over 300 grand worth of liabilities to get them under that line. So they won on principle that the sale price wasn't necessarily the market value, but it didn't mean much anyway, because it was not enough to get them under the line. So principle works, didn't work for them in practice. There's 3 other cases, XLR, Hookie and Miley, that I've listed in the paper, that all have similar kind of arguments. People arguing that what they received wasn't necessarily the value. All of them went in favour of the tax office. So there is a principle there, but you can expect a fight. you can expect an argument from the tax office if you want to be saying that the sale price to a third party is not reflective of market value. So that's, I suppose, something to be wary of. Market value, a number. As I say, when they're related party transactions, always get a valuation, always. Why? Because the burden of proof is on you to prove to the tax office a value. If the tax office want to dispute it, they no longer have a valuations office within the tax office. They disbanded that a number of years ago. So if they want to get a valuation done, just like we do, they have to go out and instruct the valuer and pay them. So if you've got a contemporaneous valuation independently done according to APIS 225 and all that kind of valuation methodology stuff, bang, that's good evidence. They would need to think, no, this is well off the mark, and be able to go and get another valuer to come up with a report that disputes that enough that obviously causes you a problem with that $6 million test. The disputes we see are where related parties, families pass assets around, move them down to their children, and do their own valuations and think they're safe. Now, obviously, if the thing's worth $3 million and you think it's worth two and a half, and you don't have a lot of other assets, it probably doesn't necessarily matter from the 6 million point of view, because you're well under. But if you've add that all up and you're at 5.5 or 5.8, that's clearly when the tax office is going to say, we don't need to get much out of this to knock this one away. So that valuation is important. The N in MNAV test is net assets. So as I said, it's market value less liabilities. So we get to reduce those market values by liabilities. So legally enforceable debts due for payment or presently existing legal obligations to pay an ascertainable sum. So as accountants and financial planners, we all know what liabilities are. Those liabilities that we can offset against the market value of assets. They need to be related to the assets. They've specifically allowed certain provisions. Whether you account for them or not, they've allowed certain provisions. So provisions for annual leave, long service leave, even if you don't account for them, you can in this calculation. Provisions for unearned income, again, you might not account for them. From a tax point of view, you would want to, but even in your accounts, if you account for them, they're a liability that can reduce net asset value. Provisions for tax, again, you might not account for them, add them up, put them in as a provision in your calculation. Again, you want to get as far below 6 million as you can, because when the tax office asks you to prove it, if you send them back a number that says, as I said, 5.2 million, that's less likely to get looked at than one that says 5.8. So you want to make sure you get all that. It says presently existing obligations to pay an ascertainable sum. So that essentially precludes contingent liabilities. But there was a case, Burn Hotels, that dealt with a company selling a hotel. And it sold the hotel, and as a result of selling the hotel, was liable to pay the real estate agent a commission on the sale of the hotel, several $100,000. Legal fees and accounting fees that had yet been invoiced were all sort of carried forward. Other settlement costs as part of that. Now they argued that those should be liabilities connected with the hotel because they only arose out of the sale process of the hotel. So they should reduce the value of the hotel. Now the tax office, and I can understand their argument from a literal point of view, said, well, hang on, we are doing this test just before you sell the hotel. So just before you sell the hotel, you don't have that liability, so we can't include it. Literally, I can see what they're coming at, but it's probably not fair. Not that fairness finds its way into the Tax Act anyway. Thankfully, though, the court looked at a bit of fairness and they said, no, it's clearly connected. You couldn't ever trigger the sale of this without these other liabilities being attached. And thankfully, rather than take it on or just dismiss it, the tax office accepted that decision. So costs associated with the sale and essentially crystallised on the sale can still be included as liabilities to be offset against net asset values. And again, it might not sound like much, but if you're,
That must be
close to the limit, yeah, if you're close to the limit, then you'll take anything. You'll take whatever you can get. And I've done a few that have been very close to the limit. Liabilities, as I said before, must be related to the asset. So clearly, if it's a debt secured against an asset, easy. Fixed and floating charges, they'll accept that that's connected to the assets. If it's an overdraft that's used in a business for working capital purposes, they'll accept that's connected to the sort of goodwill of the business. So there just needs to be a connection to an asset that is included in the calculation. UPEs are a common liability in a trust, so distributions that we haven't actually paid. In that ruling 2015-4, the tax office says, yep, their liabilities will accept that essentially it's a distribution made by the company and by the trust for tax purposes and trust purposes, but the funds are retained and they're used within their operations. So unless that's gone out somewhere else as an asset that is excluded, then they would include it. However, the UPE is also an asset at the beneficiary level. And if that beneficiary is connected to the trust, then we take all of their assets in as well. So essentially the liability offsets the asset. So it was there, now it's gone. So from a planning point of view, I mean, most of those things are what they are. Its value is what its value is, and the liabilities are what they are. Some of the planning can come in this next step, which is there are certain assets that you exclude from that $6 million test. And obviously they're good assets because they're not adding to your sort of asset value. Because we include all of the assets of a connected entity, clearly we can't also include the value of shares or units. That would be double counting, so we can't do that. Personal use assets. So assets used solely for the personal use and enjoyment of an individual are excluded. I'll talk about that when we get to those tax office IDs on what they believe solely for personal use means. But we're talking, a holiday house, a boat, an expensive car, those kind of things that wouldn't necessarily have any kind of business use to them. But they've got to be owned by an individual. If they are owned by a trust, even though it might be the holiday owned by a trust, it's included. It's got to be owned by the individual solely for the personal use and enjoyment of the individual. So I'll get back to that in a moment. Super funds, life insurance policies, and insurance bonds. So this is a good planning opportunity. Any money in a super fund is excluded. Now I know it's slightly difficult to get money in super funds, but you can get, 600 grand between mum and dad, non-concessionals up in lump sums. If they have that money around, or they've got other assets, liquid assets that, are tipping them up or getting them close to that level, if you can cash out of those and put them into super, then suddenly they've gone from an included asset to an excluded asset. Insurance bonds is the other one. I don't see a lot of these around, but there are insurance bond products. I think after 10 years they're tax-free, and 9 years it's 2/3, and 8 years 1/3, whatever. But if you forget the tax sort of benefits of that investment, any money that goes in an insurance bond is excluded. And I don't believe that it matters who puts the money in an insurance bond. So a company or a trust could put money in an insurance bond, and I think that would also be excluded. So putting money, excess money, or cashing out of liquid investments and putting it into super funds or insurance bonds certainly is a plan to reduce your net asset value. Now, what happens when we plan? Tax office doesn't like plans. Doesn't like plans that are designed for the dominant purpose of generating a tax benefit. So if you did this today and on Monday your client sold their shares, you'd expect a question. So plan early. If the client is, next year we're going to sell our business. All right, let's do a bit of a, spreadsheet. Where's your asset position? You're at 6.2 million. Got some excess cash there, you got some BHP shares or whatever. Maybe we should look at selling some of those assets, maybe contributing to super, get some SOA stuff, all that license stuff. I'm not telling you to do anything here. And then, rejiggle or reset that asset cap. So when they do sell in 6, 12, 18 months, they're under.
The insurance bond's an interesting one, isn't it?
It is,
There's no
yeah.
limitation to what can work in there.
Yeah. Yeah, that's, I've never had anyone who's really needed to use it, but I know Hartley, years ago, I went to a presentation with Hartley's and they were all over these insurance bonds. But the bloke had no idea of the bet, and I said, were you aware that actually does, that could be a selling point for you? Leaving aside Part 4A, but it could be a selling point in terms of there's an opportunity. Now, whether they keep it in there for the full 10 years to get the full benefit or not, they've got a benefit up front. Obviously, the longer you keep it in there, the less likely the taxman would attack the other one. The other excluded assets, the main residence of the taxpayer. So this is interesting because the view has typically been, because you do the test just before the CGT event, the property needs to be your main residence at that point in time. So if it's your main residence yesterday, we sold these shares today, then it's excluded. But I've heard that the tax office, at least in settlement negotiations, which is kind of off the record, off the books kind of stuff, has been willing to accept that if a property has been a main residence in the past, but is now maybe rented out, so that when it's sold, proportionately, maybe 80% of it's tax-free and 20% of it's taxable, that they would be open to considering 80% of the value of that house as being excluded and 20% as not. Now, it doesn't seem to make sense to me from how the law's drafted, and settlements are typically just, let's move this case on, we don't want to take it on anymore. The flip side of that, though, is perhaps what I don't want to be dealing with is if you'd had a property that was not your main residence, and then 2 years ago you moved into it, it's quite a valuable property, and it's now your main residence. If they're prepared to allow it the other way, then isn't it now, well, only 20% of the value is excluded and 80% is included? I've typically gone on the basis of if it's your main residence now, it's all out. But I suppose it depends what situation your client's in as to which argument you might want to use. And assets, I've already spoken about assets of your affiliates. They're only assets of your affiliates that are used or held ready for use in your business. So even if you identify affiliates of a taxpayer, very few of their assets would ever get aggregated with yours in your $6 million test. Let's look at that sole personal use because that's I suppose got some levels of dispute with the tax office on it. The tax office view is that sole essentially means forever and 100%. So a bank account, they say, an interest-bearing bank account is not solely for personal use because it's earning interest. So at least some part of it, even no matter how small the interest rate is not solely for personal use. So you win the lotto and put $1 million in a bank account and you expect to blow all that on yourself in the next however long, purely for your own personal use, that $1 million will be added to your test.
But buy a holiday house with it and it's excluded.
Yes.
It's nonsensical.
Exactly. Or put it in an insurance bond
Yeah.
and then cash it out and then blow it up. It's so vacant land. So you bought a block of land that at some point you want to build a holiday house on or your own house on, but if you haven't done anything, the tax office view is that no use is not personal use. You've got to use it for your personal use. So if you start to build, or you're going through the building process, that's fine. If you're not sure you can put your caravan on it, a holiday down there, probably don't allow that anymore, used to be done back in the day, that might be personal use. But if there's no use, that's not sole personal use. So you've actually got to demonstrate personal use. The holiday home is the most sort of contentious, because the tax office view is, if it's ever been rented out, ever, it's not solely for personal use. So the $5 million holiday house in Eagle Bay that the family's had forever, rented out for 1 month on Airbnb while they all have their, skiing holiday. But for the last 10 years, always been theirs. That's now included, and not proportionately included. The whole $5 million is included. So that's not great. There's no de minimis test that the tax office look at. Any drop of income, bang, it's no longer solely for personal use. If it's used by your friends or your family, provided they don't pay, that's fine. But if they pay, well, not solely for personal use. So something that we've used in the past that is, potentially a strategy, depending on how the tax office might want to approach that main residence position we looked at, is that if a holiday house, a particularly valuable holiday house, has been rented in the past, if at the time of the sale it's actually the main residence, so the taxpayers moved into that for a sufficient enough time to make it the main residence, not something that they could again attack under a Part 4A type argument, then the general view is, well, it's a main residence at the time. The fact that for 10 years before it's been rented on Airbnb, if you've moved into it a year or so ago and it's now your main residence, it's excluded. So there are some things you could look at there. Again, it depends where you are on that scale of your asset values.
So clients have moved to Eagle Bay when you're advisor.
I wish I would. Wish someone give me that advice. Wish I had a $5 million house down there too. Well, it'd be worthwhile, wouldn't it? For a lot of reasons. Related party loans. So, Breakwell case, the company was doing the $6 million test. So it had sold some assets, wanted to claim the concessions. It had made a loan to a shareholder of $1.1 million. It made that loan prior to 1997. So before Div 7A came in. So like most pre-97 loans, it's just been sitting there for 20 years, doing nothing. Breakwell tried to argue, the company tried to argue, that asset, 1.1 million, should not be included in our $6 million asset test because the loan has become statute barred. So you probably heard me talk about that from a Div 7A point of view. Statute of Limitations Act in WA, if the loan essentially has not been acknowledged in any sense for 6 years or more than 6 years, then it's become statute barred, which means the borrower cannot essentially, is not required to repay the loan. There's a defence to that action. So I want my money, it's statute barred. That's a defence to the repayment, which has some Div 7A connotations, but for this point of view, they said, so if we can't collect it, it shouldn't be an asset. Reasonable? The court said it might be statute barred, but it still exists. It's still an asset. There's just a defence if that party refuses to repay it. So it still should be included in the $6 million test. Now, they didn't argue this, but I would have thought maybe the argument might have been on the value of the loan. So if you've lent someone $1.1 million and it's statute barred, then it might still be there as an asset, but what's it worth? Is it worth 1.1 million? How do you recover it? What's the likelihood that that party will repay it without pleading that defence of statute bar? Or, better still, if you're sure it's statute barred, which means it's not going to cause a Div 7A problem now, you forgive the loan. So you actually formally write the loan off. And then it's no longer an asset. And as long as that's done before the CGT event, it's not there. And again, if it was statute barred a number of years ago, Div 7A can't apply today. They didn't argue that either. They just argued it wasn't an asset and lost. So that's the $6 million test. That's that first one. Adding up all the assets, taking off the liabilities. Finding the affiliates and their assets, finding the connected entities and their assets, adding that together. Seeing whether we can disregard anything to get down hopefully under $6 million. If you can't pass that, they introduced the SBE test a number of years ago. So that was there for your lower turnover, high value. So typically your market gardener, farmer type taxpayers who had low turnover, but typically their land value was exceptionally high and higher than 5 million and now the $6 million figure. So those taxpayers don't need to worry about the value of their assets. Doesn't matter what they are, provided they are an SBE. So that is, they carry on a business and their turnover is less than $2 million. So you will know that the small business turnover increased from 2 to 10 for all but this. So these people are now called a CGT SBE rather than everyone else who would be an SBE if their turnover is under 10 million. And that test, or those tests, you can do really whatever suits you. You can either do what was last year's turnover, we're selling today, what was the 18 turnover? Less than 2 mil? Great. We're an SBE in 19. Or what's this year's turnover? So we might have been 2.1 million last year, but we're 1.9 million this year. So in 19 we're an SBE under test 3. Rarely for CGT purposes would you use test 2. That's a sort of estimation during the year. Now you wouldn't need to know today whether you're an SBE. You might for other SBE concessions, and that's why you get to use that likelihood test. Typically it's either what was last year, what's this year. How do you work out turnover? Well, 2 parts to that. One is turnover is annual turnover. The total ordinary income derived in the ordinary course of carrying on a business. Secondly, it's aggregated, i.e. it's the annual turnover of your connected entities and your affiliates. So again, you don't want too many of those because 2 million is a pretty low number. You start adding a few more businesses to it, you're going to blow this. What does annual turnover include? Well, interestingly enough, it just tells you what it excludes, and that's not an exhaustive list. So we're looking at ordinary income derived in the ordinary course of carrying on a business. It excludes GST. It excludes the sale of retail fuel, not something that you would deal with that often. It excludes recouped depreciation, so your balancing charges. It excludes capital gains. It excludes investment income, so dividends, interest, rents, license fees. So you want to make sure you identify all of these. Not only for the CGT 2 million test, but also for the general 10 million test. You want to be under these lines so you get the benefit of those concessions. Now, just quickly, there's a case that I've mentioned in the paper called Douch that fortunately or unfortunately I actually ran, at least as far as I could run it before the barristers got involved, and that was about what was annual turnover. So it's a particularly important point because obviously if you're under, you qualify, if you're over, you don't. So this chap, he sold a tenement for about $10 million, so clearly he was going to fail the $6 million test. But he had a drilling business that used that tenement, and it turned over, well, it turned over, as it turned out, just over $2 million, about 2.4. So I'd been able to connect the tenement with the small business entity, and we sort of met all the other kind of conditions. What we were down to was was the asset, the tenement used by a connected entity that was itself an SPE. So we needed to focus on this drilling company and whether its turnover was less than 2 million. As I said, this is a number of years after the event. So the P&L said 2.4 million sales, just bank sales. So immediately you think, well, that's not good, but I looked in behind the sales. So in behind the sales, there was about $200,000 in invoices, invoiced in June for work to be done in July, August. Now the mining company wanted that for their own purposes. The drilling company were happy to do that. That's not income in that year. So was able to pull that out, convince the tax office of that company. So we're down to 2.2. There was close to 100 grand in other disbursements. So things like flights, car hire, accommodation, phones, odds and sods that were essentially client expenses that were then just dispersed onto the clients. Not what I said was ordinary income from a drilling business. So the tax office accepted that one. If you've got any mining services clients and you had them during the boom, you know that sometimes they do crazy things with their money. This company bought a $400,000 Mercedes-Benz in a drilling company and leased it to a bloke who knew a bloke in Melbourne. I don't know why. Don't think anyone needs to know why. But that bloke paid 70 grand a year to lease it. That's not drilling income. So it was just lumped into sales, pull that out. So we were down to 30 grand. I'm getting a bit excited now. Like you can just see that I've got this, and we're just whittling it away bit by bit. And I identified another $55,000 in fuel disbursements. So what happens in the drilling game is that you take a drill rig to a tenement and it's the mining company or the tenement owner's responsibility to supply diesel, because you're not allowed to cart diesel as an environmental thing. So there's usually a diesel tank there and you just fill up your rig and then you go and drill and then you fill up your rig and you keep drilling and then you go. And all the contracts say that. Diesel is the client's expense. Now there was one client, just happened to be in this particular year, and over 5 years of checking accounts and contracts, only one ever client who was a fairly new sort of IPO startup, didn't have a fuel card set up, so couldn't actually supply the diesel and needed this drilling work done. So again, you know, mates of mates of mates, the drilling company says, look, we'll buy it and we'll just disperse it to you. 55 grand through that bit of the contract. So I said, well, no, they're not fuel retailers, they're drillers. And the contract actually says they shouldn't have done this. They don't have to do this, but they chose to do it and they just added it to an invoice. So I'm taking it out of the invoice, it shouldn't be there. That would have got me under. And that's the last bit that the tax office wouldn't agree with, unfortunately. Although they agreed with it at one stage and disagreed with the other disbursements and the unearned income, and then they agreed with that and didn't agree with that. So we ended up taking this 55 grand to the tribunal and then to the federal court. And unfortunately, the federal court didn't see in our favour. I thought it was a pretty good argument. Blame the barrister, I suppose, for not presenting it well. But the view of the court was that they use diesel in the ordinary course of their business, so whether they pay for it and disperse it or whether the client does, doesn't really matter. It's part and parcel of their business, the use of diesel, and therefore that's part of sales. So we were 2,027,000, bang, gone. So, okay, it is what it is, but if you were preparing the accounts at that time and you thought about that being relevant, which I'm not blaming anyone, they didn't know that, then you would put the fuel disbursements maybe against fuel expenses. So take it out of the top, bring it down the bottom. Or they could have even just booked it as a loan. They could have just loaned that company that money in accordance with the contract, I suppose, which says you pay fuel and got it back. Any one of those, we wouldn't have had that problem. But just lumped it all into sales, lumped everything in sales. So in a sense, when you're looking at that kind of stuff, certainly if you're close to 2 or close to 10, doesn't matter if you're anywhere else, but if you're close to 2 or close to 10, think about it. Is it annual turnover? Even if you're not sure, well, if you're separated, at least there's an easier argument potentially down the track that it might not be. All right, so 2 million turnover, 6 million assets. We talked about affiliates. What is an affiliate? Talked about how there's not many assets you include. Well, what's an affiliate? An affiliate's an individual or a company, so it can't be a trust. An individual or a company who acts or could reasonably be expected to act in accordance with the taxpayers, so the entity that's derived the capital gain, with their directions or wishes or in concert with the taxpayer. So what does that mean? It's not a kind of control thing in terms of holding a particular amount of shares or having that kind of formal influence. It's more of an informal influence. And really, I've only ever argued it or seen it argued in cases relating to families. So farming partnerships is a classic one, you know. Without sounding sexist, you know, mum or the kids might not necessarily know what the hell's going on, or all of the kids might not necessarily know what's going on. Dad does everything, got all the suppliers, the whole lot. Now, they would clearly be considered affiliates of Dad or all of each other. Doesn't matter which way it goes. So you couldn't necessarily argue that they're standalone taxpayers when you're looking at turnovers if they've got other businesses, or assets if they've got assets outside of that. So it's really family kind of relationships. Directors in a company, partners in a partnership aren't affiliates just through that title. They might all be working for the same goal, they might always agree, but they don't necessarily just act in accordance with one other person's directions or wishes. It might just be that everyone's on the same page. So it's really only families that we have to worry about affiliates. Connected entities is the more difficult. And that can, as I say, be a bit of a nightmare, because we look at all of the assets of connected entities and we look at the turnover of connected entities, businesses carried on. And again, you don't add too many businesses to a $2 million turnover test. And depending on how wealthy your clients are, you don't add too many other entities to their $6 million calculation. And this one deals with control, but in a sense, more formal control. And in relation to discretionary trust, there's a level of deemed control. So a discretionary trust, obviously no one has an interest. They've got a right to be considered as a beneficiary. The only person you'd say who really has control would be the trustee. So a trustee is in, they're a connected entity. Now that's probably fine. It's probably mum and dad. We'd expect that they would be connected, we'd be aggregating their assets anyway. The appointer, who can hire and fire the trustee, they have control. So they'll be in. Now again, that's fine if that's mum or dad, survivors, whatever, but if it's someone else, if it's the family matriarch or patriarch, we'll be careful, because their assets are suddenly going to be added in. So we've got a trustee control rule. You know, who controls the trustee and the appointer and that kind of stuff. The deemed control rule then looks at distributions. But again, this one's a bit strange, because this doesn't look at distributions in the year of the CGT event. It doesn't necessarily just look at distributions just prior to the CGT event. It looks at distributions in any of the 4 years prior to the year in which you sell this asset. So if we're selling the asset today, then we need to look at distributions the trust has made in 18, 17, 16, and 15. And any beneficiary that received at least 40% of the income or 40% of the capital is a connected entity. So in 2015, the trust made a lot of money. And rather than distribute it all to mum and dad and, you know, if we've got adult kids or whatever, we've decided in the accountant's advice, maybe we distribute to the grandparents, mum and dad's parents. Self-funded retirees, makes some sense, be quite tax effective. And we distribute 40% of income or capital to them. We sell today, they are connected. So all of their assets, apart from the disregarded stuff like super funds and family home and personal use assets, which hopefully that's what they are, anything else, their share portfolio, their holiday home that they do rent out on Airbnb, that's all then aggregated with the trust. So we need to be conscious that we actually do go back a long way, 4 years prior. So you might end up with 16 connected entities. You know, if you've done in 15, 2 different people the income, 50-50, 2 different people the capital, and then 16 the same, I mean, I'm just stretching that as far as it could go, you could have 16 connected entities, all of whose assets and or turnover, if they carry on businesses, needs to be aggregated with yours. That number's looking pretty bloody small, 6 mil, not 2 mil when you start adding all that in. So what could you do there? If you didn't want the grandparents' assets connected, well, you'd have to defer the sale until July. Because in July, we're in the 2020 year, so the 4 years prior is 19, 18, 17, 16, 15 has dropped off. And the grandparents are released, or at least you're released from them. So be careful who you're distributing to, certainly in that 4 year period prior to sale. Now, I'm sure in 15, no one was even thinking of selling in 19. It just happened.
Sure, a situation where maybe for estate planning, 4 children have made a point order of a trust.
Yeah.
Mother might still be alive, but it's sort of in the process. If one of those children has got a business,
That could be a worry.
then that trust, all the assets of that trust would be included in their
Yes.
calculation.
Yep. Exactly. So they might not think that's a good idea. But they weigh that up against the fact that they then have lost control over the family trust.
As if you pay them a salary and wage rather than a trust distribution, if it's possible, it wouldn't.
But you don't want them to formally be an appointer. So if they're actually put down as an appointer, then they'll control it under the trustee control test. So yeah, you need to be conscious of that.
Yep.
For other entities, so those that aren't discretionary trusts, well, we just look at, if you own 40% of the shares, you're connected. If you own 40% of the units, you're connected. So 40%, that's that 40% test. So we've got 20%, 40%, 80%, 90% test. 39%, you're not connected. Beautiful. 40% you're there. And income, capital, voting power, we're really dealing with ordinary shares and that kind of stuff.
So Sean, where you've got the trustees in the loss position, it may not.
Oh, yeah, sorry.
Is that may or have to?
No, mate.
No.
I should mention that because you would want, if the trust makes a loss, you can nominate individuals as controllers. You would not want to do it for these purposes because we don't want connected entities. But you might want to do it if you're trying to make an asset owned by a trust connected with a company. So you could nominate the company or the shareholders of the company and that would connect them. So you would use that test for the next one. But for the $6 million test, you want no connected entities if possible, as few as possible. Good pickup. The active asset test. So that's the first condition. So we spent an hour-ish on the first condition, really. Identifying down further. How easy is this stuff? This is for small businesses. But that's the one that is typically the one that's litigated because we're dealing with a number. And although we might think as accountants and planners we're always going to get the numbers right, it's what you're feeding into that number that gets there. So the second condition is the active asset test. A CGT asset is an active asset that's used or held ready for use by you, the taxpayer, or an entity connected with you, which is why you might use that nomination, in the course of carrying on a business. So goodwill, land and buildings, simple stuff. Shares can be included, we'll get to that in a second, but it's typically goodwill, land and buildings. That's where capital gains are made. Now, this test also has a different time. It doesn't need to be an active asset when you sell it, as in just before the CGT event. It actually doesn't even need to be an active asset in the year you sell it, at any point. It just needs to have been an active asset for the lesser of either half the period you've owned it or 7.5 years. So if a client has owned a building for 28 years, and for the first 8 years they ran their business from it, and then they sold the business, but they kept the building and rented it to the new owner, and they've done that for the last 20 years. It has not been active for 20 years, but it was active for 8, which means it's always active. So once you hit 7.5 years, that asset is always active, which means this test you would always pass. Still got to get through the other ones, but this test you would always pass. So 7.5 years is important. The other side of that, if you've owned an asset for less than 15 years, so let's say in that example we rented it, we used it in our business for 6 years, so we didn't get to 7.5, then we rent it out. Once we get to 6.1 years, it's gone. It's not active anymore. So you've got clients who have assets that are active and they've been active for less than 7.5. You need to be conscious of what the cost to them would be. You know, if you keep renting this thing, 1 more year you're going to lose the active asset status, which means when you sell it, we don't get that extra 50% reduction. We don't get that ability to put money into super. So do you want to continue renting it, or should we be putting it on the market? So that's important to know when an asset's active and when it's not. Certain assets are excluded. Financial instruments, don't see those too much. Why? Because they don't generally make a gain. You don't typically make a gain out of a loan or a debenture or even a bond in some instances. If an asset's main use in the course of carrying on a business is to derive interest, annuity, rent, royalties or foreign exchange gains, it's not active unless it's an intangible asset that's been developed or altered. We're talking about, you know, IP in a sense that can generate royalties, or its main use for deriving rent was only temporary. So when they talk about main use, typically they look at floor area. So you own a building, 1,000 square metres, you run your business from 600 and you rent out 400. Its main use is in your business. It's active. If that flips around, 600 square metres rented, 400 square metres your business, its main use is rent. Now there is a view, probably a little harder to get through the tax office, that it's not necessarily floor area. It can be used in terms of dollars. So if you make $2 million from your business and $200,000 from the leasing, or if you make $2 million from the 400 square metres of office you use and $200,000 from the 600 you lease out, arguably the main use of the building for you is your business. You'll get more pushback on that from the tax office than if you just went the floor area basis, but it's an argument. The other interesting point on that one is you can be in the business of, you know, leasing property, renting out commercial property or holiday homes. And people get a little fixated on the fact that if I've got 3 rental properties or 5 commercial units, I have to manage them and I'm in the business. And that's not in dispute. The problem is, the test says if the asset's main use in the course of carrying on a business is to derive rent, it's not active. So that's not saying you can't be carrying on a business of deriving rent. It's just saying if your asset is used mainly to derive rent, it can't be active. So a client might have 50 commercial properties and spends all their time going around seeing their commercial properties and managing them and doing the maintenance and whatever. They're carrying on a business, absolutely. But none of those commercial properties will be active assets. Now, maybe one of them they use for themselves to run their management business, that will be an active asset. Its main use is not to derive rent, it's to run the other 49. But the other 49, they can't be active. And there's a bunch of cases that I've mentioned in the paper, holiday homes, caravan park sites, those kind of things where the issue comes down to what's rent. And that's not a tax issue necessarily. It's an issue of property law. Rent is basically where you have exclusive possession to a building. You rent commercial premises, you rent a holiday home, you rent a house. You have exclusive possession, that's rent. And that's distinguished from a license to occupy. So hotels, some of those, service departments are typically licenses to occupy, which means they could be active. So it's a bit of semantics there, but that's the position. So if your holiday apartments are leased on the basis of a license to occupy, they could be active. If they're rented, in the sense that the agreement gives the client exclusive possession, they're not active. So it's not necessarily a tax issue, it comes down to the property law issue. On what basis are you supplying those premises? If it's rent, no. If it's licensed to occupy, yes. Maybe because they've settled them earlier, but all of the cases, of which there are 5 I've listed there, I think, all have gone in the tax officer's favour, where they're trying to argue it's not rent. All right, so what about shares and units? So we talked about goodwill, land and buildings. We talked about determining whether it's active or not. Land and buildings, the time sort of factor. Shares and units can also be active. So if you own shares in a company that is itself carrying on business, well, the 80% test allows you to determine that those shares or units are active. And what that requires you to do is basically go into the company, look at its assets, look at the market value of its assets. So just because goodwill's not on the balance sheet, value it. And if the value of its assets, or at least 80% of the value of its assets, is in active assets, goodwill, land and buildings, debtors, cash that's used in the business, assets that are used within the business, then the shares are active. And you need to do that test, essentially, every year. Because you need to identify at least half the period you own the shares that they are active. So it can be that in some years, the shares are not active. Why would they not be active? Well, if the company has invested in something, i.e. it's had a big windfall in its business, and rather than pay dividends out, it's decided to go and buy $500,000 worth of a share portfolio. That's not an active asset. So that will count against their 80% active, 20% passive test. The main one we see are loans to shareholders. So your Div 7A loans. So the company makes that extra $500,000. Typically the shareholder doesn't say, let's go and buy, let's put it in a managed fund, or says, or doesn't like the idea of having it as a dividend where they pay the top-up tax. They just take the money. And then you have to book it as a Div 7A loan. That's an asset of the company, but it's not an active asset. So if Div 7A loans are 20% or more than 20% of the asset value of the loan, of the company, you're going to fail the 80% test. But again, failing it in a particular year is not necessarily fatal, as long as for half the period you own the shares, you pass it. So a job I got earlier in the week, so a client's done, an accountant has done that for 18 years for a particular client's company. He's worked out all the assets, he's highlighted what he thinks should be excluded, he's done valuations for plant and equipment, goodwill, some land and buildings, highlighted all the passive assets, the Div 7A loans, and just wants me to confirm that. So I need to find 8 years 8 years where we meet the 80% test, because they're looking to sell the shares now. That can be a fairly big job, because not only are you just looking at balance sheets for the last 18 years, you're also valuing. Now, are you going to go and get a valuer to value 18 lots of goodwill? Probably not. So there's a bit of estimation in that. So there's a risk. Again, if you're at 95%, it's less of a risk than if you're at 81%. But you need to know that.
Just going back to renting, let's just say the trust owns the commercial property and is renting it to the company which has the business. What if there's 2 tenants in the property? So say 20% is to a non-related party as rent and 80% of its use to the business. Is that the same?
That's fine.
Test?
Yeah, it is. So main use, are you talking about in the 80% test or in the?
Yeah, so if they had 30% of the rent derived from that commercial property was to an unrelated tenant, then they would fail that test.
No, it's still a main use test.
Okay.
So they'd be fine. It would still be considered. The main use of that asset is not rent, it's all active. So it doesn't say 70% of it's active.
Okay, so this is just the shares and units.
Yeah, exactly. So really that's it. If you've got excess cash, you've got investments, you've got Div 7A loans, they're typically the only passive things you'll see in a company that would cause you to fail the 80% test. And again, depending on how far out you are from a sale, you might have the opportunity to deal with it. Declare a dividend and wash it out. Okay, it's going to hit them with some top-up tax, but suddenly that asset's gone. It's not included in your test anymore. If you wanted to take the law literally, you should do that test continuously, every day. No, we're not going to do that. So the tax officer's view is, well, as long as it's reasonable to conclude that you pass it, so there's not a lot of massive changes in your balance sheet over the year, we'll let it go. But if there are, so if a client maybe on the 2nd of July takes out excess money from the company, puts it off their home loan, and on the 29th of June they repay it. So if you look at the balance sheets at 30 June, it's all sweet, but for 363 days there was a loan, it never hit Div 7A because they paid it back. Well, it wouldn't be reasonable to conclude that they passed the 80% test all that year. That wouldn't take too much effort for the tax office to find that. Clearly the balance sheets wouldn't show it to them. They'd have to dig into that. But you would know that as the accountant. We'll talk about that modified active asset test a little later. All right, so that's the second test. So a little bit more straightforward than that first one. And this one wasn't that bad until, as I said, they added those extra 3 from 8th of February. So this is the third test, the third of the basic conditions. So we're on a sort of homeward stretch. And this one only applies when what we're selling are shares in a company or units in a trust. So if we're selling goodwill, land and buildings, you don't have to worry about this as a basic condition. So that's good. And it requires one of those first 2 to be satisfied, and then all 3 of the A, B, and C sub-conditions. First one, the taxpayer must be a CGT concession stakeholder. This is what we call the 20% test, the original 20% test. The original 20% test requires an individual to own a 20% interest in a company or a trust, or be the spouse of an individual who owns a 20% interest in a company or trust and owns some interest themselves. So the problem with this condition when it was first introduced and for the number of years that it was in play is it really only worked when an individual held shares in a company. And we don't do that. We haven't done that for years. We would set up a trust to own the shares in the company so that when we pay dividends, we've got some flexibility. And from an asset protection point of view, the individual doesn't actually own the asset. So that didn't work for most modern structures. So they had to bring in a second test called the 90% test. And the 90% test said, okay, we will allow the interposed entity, so the trust that owns shares in the company, to qualify under this condition, but only if CGT concession stakeholders in the company, by tracing through the trust, have a 90% interest in this interposed entity, in this trust. I'll show you a diagram. It's easy to understand that way. So we have to get one or the other. Direct ownership or indirect ownership through an entity. And then from 8 February, we now have these three. We talked about that. If you don't pass the $6 million test, so you qualify as an SPE, you must have started the business before you sell your shares. Because that's fairly easy to get around. You just start the business before you sell your shares. They had to bring in a second test. And the second test says, we're now looking at the top company. We're not letting you sell shares in valuable companies unless that company itself would qualify. Policy change, but slipped in as an integrity change. And then thirdly, if the company in which you're selling shares owns shares in another company, we're just going to make it even more bloody difficult for you and require you to test through that. So let's look at that 20% test. How do we work out whether an individual owns a 20% interest, either directly under that first test or indirectly under the 90% test? Well, we look at essentially the smallest percentage of their dividend, capital and voting rights. So in a company, that's obviously through their shares. Ordinary shareholders typically have the same dividend, capital and voting rights, and they are based on their proportion of the shares to the proportion of all the share, or the total of all the shares on issue. They own 20% of the ordinary shares, then they have 20% dividend, capital and voting rights. Their smallest percentage in that company would be 20%. So we're looking for individuals who directly or indirectly have a 20% interest in the company. That's not typically that hard. One of the traps though is if that company has issued what we call dividend access shares. So if that company has issued a Class A or a B or a C class share, which essentially gives the directors the discretion to declare a dividend on that A, B or C to the exclusion of the ordinary shareholders, gives them no capital, no voting rights. The tax office view is that while the smallest percentage of the A, B and C class shareholders' dividend, voting and capital rights is zero, because they had no capital and voting rights. But what it means is, for the ordinary shareholders, whilst their voting and capital rights remain at 20%, say, their rights to a dividend are somewhere between 0 and 20%. Because we could declare, the directors could declare, 100% of the dividends to the A-class shareholder, which means the ordinary guy gets nothing. So the tax office view was, well, the smallest percentage, therefore, is 0. So, no CGT concession stakeholders, you can never pass this condition. So they took that on in the Davuba case, and essentially, again, in principle, they won, but in practice, the taxpayer won. So in principle, the court agreed that with these shares being on issue, whether they were used or not, with these shares being on issue, the directors had the ability to essentially limit the ordinary shareholders' dividend entitlements to 0. And therefore their smallest percentage was 0. But, and still have always had some doubts as to how this arose, in the Davuba case, there was a resolution where effectively the directors were precluded or restricted in declaring dividends to the dividend access shareholders. And the court said, well, because of that resolution, then clearly the A, B and C class shareholders couldn't get any dividend. So the ordinary shareholders did have a 20+% interest, and the $4.9 million capital gain could access the concessions. So very lucky they had that document. What seems strange to me is, why would you prepare that document? Why wouldn't you just redeem those shares? If you don't want people to use them, Why issue them and then prepare a document that says you can't use them? Maybe that document.
It's backdated.
I didn't say that, but it just seemed a bit strange to me. But it saved their ass.
If you had like an A, B, C, D class, they happen to have voting rights as well. So they're not dividend excess per se, but you still probably issue a dividend to one excluding the other.
Yeah.
We still got a proper.
We do. Now, the way around it, two ways around it. One is to redeem them, because this test is essentially just before the CGT event. So one is to redeem those shares, get them out. The problem with that is you close it, well, A, you might be too late. The other problem with that is the tax office says, well, that was convenient. Why did you do that last week and sell it this week? Maybe they'd try a part for a attack on that. The better thing to do is, the way the legislation is drafted, there's a really weird little sort of parentheses stuck in the middle of the test. And it says, ignore redeemable shares. So if you look at the bottom of your constitution for your clients' companies, typically class G, H, I, J shares are redeemable dividend access shares. So if your client wanted to have dividend access shares and they use them in their business, but you didn't want to fall foul of this, then redeem the A, Bs and Cs and Ds now and reissue G, H, Is and Js, because they're ignored in this calculation. So then, even if you do forget, it doesn't matter. They're excluded. But if you've got them on issue, you're in trouble. As say, Davuba just happened to pull a rabbit out of the hat, so to speak, and got through it. So that's a company, tracing companies. A unit trust, well, again, we're looking at unit holders. If there's a special income unit on issue, same kind of problems, because we're looking at the smallest percentage. A discretionary trust, sort of different again. Unlike the connected entity test for discretionary trust, we don't look at the 4 years prior. We look at this year. We look at distributions made in this year, which gives us an opportunity to plan. If we sell today out of a trust, then to determine who the CGT concession stakeholder is in a trust, we can make sure we distribute 20% of the income or capital to an individual in the 19 year. So we've got 7 months planning on that one. So that's a little easier. But in that planning, we've got to be conscious of this 90% test. So our trust owns the shares and our trust sells the shares. So it's not an individual. It needs to pass the 90% test for this condition. So what we do is essentially we need to look through the trust to identify if there are CGT concession stakeholders of the company, so individuals who indirectly own an interest in the company, and if those individuals who qualify as CGT concession stakeholders have a 90+% interest in the trust. So we sell operating company shares are sold today. 30 June 19, mum and dad, let's say it's Bill and Anna, sitting around the kitchen table with their trusted tax advisor who's been running around all night doing trust resolutions around the kitchen table on the 30th of June, as we all do. And they decide, okay, we're going to distribute 5% of the income from the trust to Deborah, who's the adult daughter. That's some good tax planning. She's been paying up money to Deborah anyway. We might as well, distribute some to her for tax purposes. Is Deborah a CGT concession stakeholder of the company? She has an indirect interest of 5%. So on its own, that won't qualify. She needs at least 20% on her own to qualify. Or she needs to be the spouse of a CGT concession stakeholder. And she's not. So that 5% is useless to us. It doesn't get included in our 90% test. Anna gets 80% of the distributions. So Anna has an indirect interest in the company of 80%, 80 times 100. So on her own, she's a CGT concession stakeholder. She's called what they say a significant individual. She owns 20% or more herself, indirectly through the trust. So she's a CGT concession stakeholder, but on her own, she's only 80%, not enough to get the 90% test. We've distributed 15 to Bill. Not enough for him to be a CGT concession stakeholder on his own, 15%, but he's the spouse of the significant individual, Anna. So that means he qualifies as a CGT concession stakeholder. We aggregate their two interests, 95, it's above 90, 15. If we'd gone 15 to Deborah and 5 to Bill, no, we failed it. And this is a tricky one, because you might just be thinking about the income, because you think, oh, we've got the concessions, it's tax-free. What about the income? We need to be, careful who we distribute the income to. I want to distribute 15% to Deborah, 5% to Bill. Gone. We only aggregate Anna and Bill's. That's 85, less than 90. What about if the trust only owns 20% of the shares of the company? That makes it a little bit more difficult. Because when we trace through the trust, we multiply our distribution by our share ownership. Anna gets 80% of the distributions. The trust owns 20% of the shares. Her indirect interest is 16%. That's not enough. It's not 20. We'd have to distribute Anna or Bill or Deborah 100%. Because then that's the only way any of them could be in their own right a significant individual. So if that shareholding is less than 100, then you've got to look at that sort of maths. And again, you look at the smallest percentage. So you would want to distribute 100% of income and capital to Anna or Bill or Deborah. Don't get smart and just distribute 100% of the income and 50% of the capital, because they'll take 50%, the smallest percentage. So that one we see a lot of people trip up on. And again, they shouldn't, because that's one you can plan for. You sell today, you've got 7 months to figure out how you should do this. It's not like the other ones, which essentially need to be in place before you do it. All right, good timing. So let's look at those last ones. So that takes you all the way to sort of 7th of February. Any sales after the 7th of February, so from the 8th onwards, 3 new conditions are brought in. But again, only when you're selling shares and units. And you've got to satisfy all 3. So the first one, pretty simple. Shareholders selling shares, whether it's a trust or an individual. If they fail the $6 million test and they're looking to qualify under the SBE test, then they need to have carried on a business before they sell the shares. Now the loophole that they were stopping with this was that people would sell the shares in a business. Let's say they own 25% of a $20 million company. So they would sell the shares, they'd make their $5 million, and they had other assets, so they were over the 6 mil. So they couldn't qualify. So they'd say, all right, well, I need to be an SBE. How can I be an SBE? Start a business. So they start a business. And as long as they're an SBE at the end of 30 June, the end of that year, then they qualify. So it was a fairly easy way to get around that $6 million test, really because they didn't think that hard when they brought the SBE test in. They were looking at market gardeners and farmers. They weren't looking at shareholders who were then becoming market gardeners or farmers or lawnmower or delivery drivers or whatever they were going to be to then qualify as an SBE. And whilst they let that go for a while, and we got a few clients through on it, they then started to get a bit heavy and apply Part 4A. And our last one, which was a pretty big one, this guy sold shares for 25 mil and then started up a pretty sort of crappy small business later that year. They challenged him under Part 4A. The only reason you set up this business was that you would qualify. So that didn't go well. We had to settle in a sense. That then led to them saying, well, we don't want to keep whacking everyone with a big Part 4A stick, we might as well just fix the law. That bit though didn't fix it completely, because it just said you need to start a business before you sold it, not after. Anyone with a bit of planning would say, fine, I'll do it the day before. I don't care, there's bloody milk barrel or whatever, I'll buy the day before, easy. So then they brought in this condition. But as I said at the outset, this one goes a lot broader, because this one not only looks at the taxpayer and what they're doing and their tests under those first and second conditions, it then looks at the company in which you're selling the shares. And this didn't apply before. This is completely new. So if the company in which you're selling shares is not an SBE, turning over less than 2 million, or does not qualify under the $6 million test itself, then you won't qualify, regardless of whether you only own 25% in a company worth 10 million. Your interest is only worth 2.5, but the company's worth 10, so you fail. And the 20%, the extra 20% test that we were talking about, says when you're working out whether the company in which you own an interest in is worth $6 million, then any entity in which it owns at least 20% in, you add all of the value of that as well. Whereas before, you had to get to 40% before you aggregated all of the assets. So it essentially just makes it harder for any entity to fall under the $6 million test. So it needs to be really a standalone entity with no other interest in any other entities, and itself be worth less than $6 million. And as I said, that's taken the testing from the taxpayer level up to the company level, and then added that new 20% test for some strange reason. You know, as if it's not hard enough, then we'll say, oh, we don't care if you only own 21% of another $4 million company, you've got to include the whole $4 million on top of your value as well. Whereas in the past, you'd only include 840,000, 21% of it. Great.
So partnership and trust would become the flavour of the month again? Would that be?
Yeah, it could do again, actually, yeah, you're right. A partnership of trust. So your trust, you're selling your interest in a business, you're not selling shares and units. So you don't have to look at that. Yeah, so they push you back to that more convoluted, in some sort of structure.
Mm.
So yeah, you look at that company. The company you're selling shares in, if it's worth 6.1 million, 7 million, 8 million, 10 million, gone. You could have 5 shareholders, each holding 20% of it, who on the 7th of February could have all sold and all claimed the concession. On the 8th of February, sorry guys, it's gone. So from your point of view with clients, if you've got clients who have interests in companies that are worth close to $6 million, you know, is there an opportunity? Is that entity ripe for restructure? I.e., the share's not necessarily where I want them to be. Well, maybe we should restructure that thing now and take advantage of these concessions, because we're about to be out of them. So there's a little bit of that use it or lose it. So they've really screwed down the ability for most to claim. Assuming you get through that one, the modified active asset test then says, well, okay, well, if you want to determine, again, sort of takes you back to the second condition, quite strangely. This probably should be as a sub-condition in the second condition. But it says, well, if you're selling shares in a company and you're working out the 80% test for your company, then if your company owns shares in another company, what they call the later entity, then you don't just do a sort of reasonable 80% test for that later entity. You've actually got to do a proper test. And if that later entity, only 81% of its assets are active, then only 81% of the value of your shares will be included as active. 19% will be included as passive. And again, it depends where you are at your company on that 80-20 spectrum. That might tip you over. They also say, if that later entity is itself not an SPE or wouldn't pass the $6 million test, then all of the value of that other entity that you've got, your interest, is passive. It can't be included. So if your client owns shares in a company that owns 10% of another company that is worth $6 million, then their 10%, $600,000, would have been considered active before, provided that $6 million company was active. Now, that $600,000 is passive because you own shares in a company that no longer qualifies. That's got nothing to do with the mischief they were talking about, but it just ended up there. So again, partnerships of trust or trusts owning various companies. You don't want a trust owning a company which owns another company which owns another company, or at least interest in it, because you have to trace through all of them. Not what small businesses are wanting you to spend your time on. Spreadsheeting. So just to wrap that up, and I've got a quick case study, and then we can have some lunch. They're generous concessions. They've always been generous concessions. They are the sort of Christmas present to small business, but they're just being tightened and tightened and tightened. So there was a loophole. They could have closed it much more easily and specifically than they did. They could have just, I always thought, why they just don't tie the asset to the small business. So if you're a small business entity, you get the concessions in relation to an asset used in that small business. And then if you're selling shares and you're trying to argue you're a small business entity, well, the shares have got nothing to do with the small business entity. Would have been an easy fix. But what they've done is overcomplicated it and taken out a raft of people who would have previously not been involved in the loophole, but now are suddenly out and probably don't even know they're out. It's just more complex. It is more complex than it was. And at the same time, this is one the tax office looks at. So not a complicated tax law, but not a lot of it gets a lot of ATO attention. This does. This gets a lot of ATO attention. So if you've got a client that wants to claim it, then you really want to have a good think about it. Get the advice, do the advice yourself, whatever you need to do to be sure that when you make the claim, you can defend the claim. I don't know if I said it up front. The other thing is, if you make the claim, get audit insurance. So it's a cheap sort of funding option for your client, because sometime in the next 2 or 3 years they'll get a review, and then at least your fees can be covered by the audit insurance. All right, so just to finish off, and we'll jump that lunch out on the table. This actual example is in the EN. So this is when they brought the legislation in. This is to highlight the loophole. And interestingly enough, when I've been doing presentations over the years and highlighting the loophole for others to, consider, I used to always call it the Twiggy Forrest loophole. And this is not dissimilar to a Twiggy Forrest type scenario, although it's, got less zeros on some of the numbers. Because the view was always, if you own between 20 and 40% of a company, you were a CGT concession stakeholder, but you weren't connected with it. And because you're not connected with it, you don't include all of its asset value, nor importantly, do you not include all of its turnover. So that 20 to 40 sweet spot was a really good place to be. So John was in there. He owned 30% of mining company, turned over 20 mil, not an SBE, valued 100 mil. Clearly not passing the 6 mil test. The mining company would satisfy the second condition. So it's the shares are active assets. You look through the mining company, it's got all these active assets, no Div 7A loans or dodgy investments. It's a business. So clearly would satisfy that second condition. He sells the shares for $30 million. So he goes to his accountant and looks at the small business concessions. Let's start from the end. Is he a CGT concession stakeholder? Yes. He owns 20%, individual. So the easy bit, not the 90% test, the easy bit. Are the shares an active asset? Yes. Satisfies the 80% test. Last condition, or first in the order we went through, does John pass the $6 million test? No. Is he an SBE? He says, hang on, I could be. I'll go and buy a lawn mowing business. This is the example they used. He's in Twiggy Forest around Cottesloe mowing lawns. So John purchases a lawn mowing business. And for the rest of the year runs the lawn mowing business, doesn't turn over $2 billion, not surprising, therefore qualifies as an SBE. So John's ticked all the boxes, which means based on the conditions under the old rules, he would qualify. So he would get the discount, 30 million down to 15 million. He'd get the 50% active asset reduction, 15 down to 7.5. He could put 500,000 into super, he'd pay tax on 7. Not a bad gig, that's pretty good. And that's how the law was. Now clearly it was a loophole. Everyone who was practicing in it knew this loophole. For years, we were driving trucks through it. And then the tax office obviously decided we shouldn't be allowing this, so they started threatening Part 4A. Never took any one of them to court, but that was enough to get us to sort of pull our heads in and tighten things up a bit. But they clearly needed to just close the damn thing, rather than try and fight it, just close it. So what do the new rules do? Well, the new rule says John needs to be carrying on a business before he sells the shares. Well, that's not enough. Okay, it stopped John doing this, buying the business after, but smart John just buys the business the day before. So what does the object entity test say? Well, it says, okay, forget about John. Let's look at mining company. Does mining company satisfy the SBE or the $6 million test? No. Gone. So clearly it worked in terms of stopping John. The problem was it stops anyone who has an interest in a company worth more than $6 million, which is not what the loophole was there for. So it's gone way further than it should. And that's a bit disappointing because that, I would have thought, was a policy change, and that needed a little bit more than just Treasury rushing it through as integrity provisions, which all politicians think, oh, we need integrity, so you can't have a lack of integrity. Let's get that through. So that's a worry. So if you've got clients who have shares in companies, they're looking for the small business concessions, you might need to revisit that because it may no longer be available. There was not, even though there were people at the TIA and the other professional bodies were highlighting this, it didn't stop it. It just raced through. But again, they're too worried about other things than whether it's the right law. So